All right, let's dive right into the art and science of financial modeling. We're not just going to be talking about spreadsheets here. Think of this as building something powerful and effective from the ground up. It's a skill, honestly, that's absolutely critical if you really want to understand how a business works. So here's our game plan. First, we'll cover the what and why, gotta know what we're building. Then we'll lay out the blueprint for success. After that, the really fun stuff, forecasting the future. Then we'll dig into some core mechanics. And finally, wrap up by learning how to sidestep those really common and, let's be honest, frustrating pitfalls. Okay, first things first. Before we can even dream of building a great financial model, we need to be crystal clear on what a financial model even is. And more importantly, what's the difference between a so-so one and a really great one? Let's get on the same page. At its absolute core, a financial model is just this. It's a story about a company's future, but told with numbers. It's basically a tool that takes what a company has done in the past and uses that to project what its key financial statements, the income statement, balance sheet, cash flow, are probably going to look like 5, maybe 10 years down the road. Pretty much anyone can just cram some numbers into a spreadsheet. But to build a model that's actually useful, one that gives you real insight and is actually reliable, well, that's a whole different ballgame. So what's the secret sauce? What makes a model truly great? This right here, this gets to the very heart of it. A great model isn't just a complicated mess of numbers. It's elegant. It should be dynamic, meaning if you tweak one little assumption, the whole thing updates seamlessly. It should be systematic and driven by just a handful, ideally just 3 to 5 key drivers, not 100. And maybe most importantly, it has to be easy for someone else to pick up and understand. It should just make sense. Okay, now that we know what we're aiming for, it's time to be the architects. The structure of your model, it's like its skeleton. Get it right, and the model is strong and easy to work with. Get it wrong, and, well, it becomes a total nightmare. So let's lay out the perfect blueprint. Think of your model like a professional report. You'd start with a cover page, right? Then you give the bottom line right up front in an executive summary. Next, and this is crucial, you list all your assumptions. This is you showing your work. And finally, you can have a scenarios tab to play around with best case or worst case outcomes. This flow just makes logical sense, and it means anyone can open your file and immediately get what you're trying to do. And hey, just a quick note on style. You can set up your tabs vertically on the side or horizontally along the bottom, which is what most of us are used to. Honestly, there's no single right way to do it. It's totally a matter of what you prefer and what feels most organized to you. All right, let's talk about a classic Excel trap. This gets so many people. You've got this great-looking title, and you want it perfectly centered across a bunch of columns. Your first instinct is to hit that button you've always used. But is that the right move? What's the pro way to do this? And here is the answer. The pro move is using center across selection. Why? Because merge and center is a disaster waiting to happen. It literally fuses cells together, which can completely break your formulas and make sorting impossible. Center across selection makes it look the same, but it doesn't break the underlying grid. It's a tiny detail, I know, but it will save you from massive headaches down the line. Okay, now we're getting to the real engine of the model, forecasting. This is where we take our beautifully structured spreadsheet and actually start predicting the future. We'll use our key drivers to make some smart, educated guesses about where the business is headed. Let's try a little real-world problem. So, you've got a retail company. It has 100 stores, which add up to 400,000 square feet, and it makes about $500 in sales per square foot. This year, they're opening 5 new stores, all the same size. So what's the total revenue going to be for the year? Go on, give it a thought. $210 million. Boom, that's the answer. But, the number itself isn't the most interesting part. What's interesting is the logic we use to get there. So, how do we do it? See, it's just a simple, logical chain of events. First, we find the new store count, 105. Then, we figure out how big each store is, 4,000 square feet. Multiply that by our new store count to get the total area, and finally, multiply that by the revenue per square foot. Every step just builds on the last one. That's financial modeling in a nutshell. And this whole idea leads us to a really powerful concept called operating leverage. Think about it. As that retail company sells more stuff, the rent on its existing stores doesn't change, right? Those are fixed costs. That means that as their revenue goes up, their profits actually go up even faster. It's a concept that can seriously supercharge a company's bottom line. Okay, we've got the big picture down. Now let's zoom in on a couple of the more technical but totally essential parts of our model's engine: depreciation and working capital. Don't worry, they sound scarier than they are. We'll break them down.
So, building a depreciation schedule is basically a two-step process. All depreciation is, really, is an accounting trick to spread out the cost of a big purchase, like a building or a vehicle, over its useful life. So first, you have to account for the depreciation of everything the company already owns. And then you have to account for the depreciation on the new stuff, we call this CAPEX, that it buys during your forecast. Getting this right is so important for calculating things like taxes and the true value of the company. Now, you might see this line item called deferred income tax, and it can be kind of confusing. But really, it's just about timing. A company might tell its investors it's depreciating a machine over 5 years, but the tax man might let them write it off faster, say over 3 years. That creates a temporary difference in the reported profits. Deferred tax is just the accounting entry that smooths out that difference over time. Okay, let's do another quick calculation. This one's all about working capital. A company brings in $412.6 million in revenue for the year, but at the end of the year, its customers still owe it $32.6 million. So, on average, how many days does it take this company to actually get paid? And the answer is 28.8 days. You get that by dividing the accounts receivable by the total revenue and then multiplying that number by 365. And this number is a huge deal. It tells you how efficient a company is at turning its sales into actual cold, hard cash. We've done it. We've built our model. It looks amazing. But now we're at what might be the most critical step of all: quality control. This is where we hunt for errors, fix the common mistakes, and make sure our beautiful creation actually works perfectly. I'm telling you, there is no worse feeling for a modeler than a balance sheet that doesn't balance. It's the absolute worst. But 9 times out of 10, the culprit is one of these 3 things. You either have the wrong sign on your CapEx, you made a mistake in the working capital math, or you messed up how the dividends are linked. This is your troubleshooting checklist. All right, final scenario for you. Your masterpiece is complete. It's got 50 tabs, it's a thing of beauty. You're about to send it off to your boss or hit print. You take a deep breath, but hang on. What's that one tiny little thing you might have forgotten that could cause complete and utter chaos? Always, always, always remember to unselect all the sheets before you do anything else. If you've been working with multiple tabs selected at once, any change you make to one sheet is secretly happening on all the others too. Forgetting to unselect them before one final tweak can corrupt your entire model without you even realizing it. Trust me, it's a simple tip, but it's going to save you one day. Because at the end of the day, a great financial model isn't just about telling a story, it's about making sure that story is rock solid. Happy modeling!